Good morning and welcome to another live technical analysis session. As usual, we're going to be starting off with the euro against the US dollar. If I'm not mistaken, Germany's ZEW economic sentiment figure was released moments ago, and this is the reaction. So it came in lower than expected, which might imply a weakening from the German consumer side in terms of the German economy. That in turn appears to be weighing on the euro against the US dollar. Now, this is a 15-minute chart. If we look at the 4 hour, however, you can see that it has broken above our S1 support level at 1.1120. The next possible target for the bulls could be at 1.1200. If you look at the daily chart, this is even of higher significance. As you can see, it is currently attempting to break a lower high that was formed. So we had a lower low, lower high, and then another lower low. However, in the most recent price action, the euro does appear to be moving in an upwards fashion, with the wick testing and validating our support level, as we had mentioned before. The next target, as we said, is 1.120, so that is a potential target for the bulls if the euro maintains its current momentum. If it does not, then we could see a reversal, breaking down below S1 and even taking aim for S2 at 1.10. Overall, it will depend predominantly on the release of the US retail sales rate, which is a gauge of the resilience of the US consumer. Should it come in as expected or lower, which would be lower than last month's figure, it could then imply a weakening from the US consumer side. In turn, this could weigh on the US dollar and could allow the euro and other pairs to gain against the dollar. On the flip side, should it come in higher than expected, implying a more resilient consumer side of the US economy, it could instead provide support for the US dollar and thus could weigh on the euro. And we could see the price action reversing course and potentially breaking below S1 and even making its way down to S2. For now, however, we will be maintaining our S1 and our S1, S2, and S3 support levels, with some minor edits potentially being required for the resistance level RR2. We're taking these that old price action. You can see found resistance. So we're taking roughly these candles here where it might meet resistance. We can adjust R3 and bring it slightly lower. We can see resistance at this point as well, and that is very nice. So we are going to be readjusting our R2 and R3 resistance levels. R2 now becomes 1.1325, so rounding that to the nearest fifth. So that is R2. R3 becomes 1.1425. So we have R1, R2, and R3. Currently, though, with the RSI at 60, it does imply a bullish market sentiment for the euro against the US dollar, at least on the daily chart, and thus could provide support for the euro. For our bullish outlook to continue, we would require a clear break above our R1 resistance line, which we mentioned before. Moving on to the US dollar against the JPY, you can see that the JPY is strengthening against the US dollar. So we have placed support at 1.3720, but it is currently on our old R1, which I'm presuming we have placed at after this wick lower. Now, this indeed is instead of resistance support at S1. We would like to note the interest rate decisions from the Fed, BOE, and BOJ, which are all set to occur this week. If I'm not mistaken, we have the Fed, then the BOE, and then the BOJ on Friday. So it's going to be high volatility. The Fed is expected to cut by 50 basis points, according to Fed funds futures. If you ask me, I think that is a bit too overambitious. A 50 basis point cut for me would essentially not validate, it would imply that the Fed is concerned about a potential recession in the US economy. I would prefer to see a 25 basis point cut, which would acknowledge the recent loosening in the labor market, but not to a degree upon which it requires a rapid intervention of a 50 basis point cut. That for me would imply that the US economy is still strong, but may require some support. If they cut by 50, then I would be concerned about the US economy, as it would indicate a radical shift in the Fed's monetary policy decisions. Nonetheless, we currently have S1, S2, and S3 in addition to the resistance lines for this particular pair. Now we have a few scenarios in play. Assuming that the Fed cuts by 50 basis points, we could see the yen strengthen against the US dollar. As such, USD JPY could continue in its downward trajectory, which we also mentioned, which we can also see from the downward swing trend line, in addition to the RSI being on the 30 figure, implying a strong bearish market sentiment. So, under the assumption that the Fed cuts, the JPY could strengthen. And then, if the BOJ unexpectedly hikes in their meeting on Friday, we could see the yen strengthening even further against the US dollar. So, that S2 target and S3 could be in sight by the end of this week. For now, we are maintaining that bearish outlook. We still have the downward moving trend line. It is above RS1 at 140.15. The RSI is at 30, implying a strong bearish market sentiment. So I would be maintaining that bearish outlook. If it bounces off S1 and then fails to break above R1, we could see a downwards moving triangle being formed. This would be the first touch, and then I would require testing S1 once again, and then we could potentially put in play a downwards moving triangle. For now, we do have only a downwards moving trend line and the RSI to support our bearish outlook. For the British pound, the Bank of England is expected to remain on hold. So that is a bit interesting. The pair does appear to be moving in a sideways fashion, having broken above our downwards moving trend line that had been incepted, I'd say, towards the end of August. RSI is at 64, which does imply a bullish market sentiment. But for that to occur, it would have to break above R1 at 1.3260. Otherwise, I would be maintaining that sideways bias between S1 and R1. So S1 being at 1.3030. Now, depending on the accompanying statement from the BOE, if it is hawkish in nature, it could provide support for the British pound. If it is dovish in nature, it could potentially weigh on the British pound. For now, we are maintaining that sideways bias as long as it does not break above R1. If it does, we would flip for a bullish outlook. USD CAD. Now, it's an interesting story. The US dollar does appear to be moving in an upwards fashion against the Canadian dollar. You can see that this upwards moving trend line, which we had placed, if I'm not mistaken, 2 weeks ago, is still valid. It is currently finding resistance at R1 at 1.3590. Overall, does appear to be moving in an upwards fashion. Now, there is a bit of an issue with the RSI, which could be cause of concern for a sideways bias, so between S1 and R1. The Canadian dollar might be finding some support in terms of oil prices, which I'll be opening the chart currently, and then we'll come back to the USD CAD. As you can see, oil prices do appear to be moving in an upwards fashion, having broken above our resistance level at 67.90. There are a few circumstances and news that could potentially have aided oil's price. One is the Iraqis reaffirming their commitment to the voluntary oil production cuts put in place by OPEC, so reducing supply, pushing prices higher. The second could be the recent weather phenomenon in the US, which has caused oil production to be temporarily halted in a few regions, so reducing supply further. We are looking towards that API figure at the end of today's trading session. If it implies a greater drawdown, then that could further aid oil's price, or essentially could provide support for oil's price. And having broken above R1, now turn to support, we are switching for a bullish outlook in terms of crude oil. Now, given that Canada is an oil producing nation, the increase in oil prices could be also providing some support for the loonie, which is why we might be seeing a strengthening of the Canadian dollar. Staying on Canada, we do have the release of the CPI rates later on today. So the headline rate is expected to showcase easing inflationary pressures, which in turn could weigh on the Canadian dollar. So it's a bit of a 50-50 scenario. As long as this upwards moving trend line is still valid and has not been violated, I would be maintaining a bullish outlook. If it gets violated, then we could stay between in a sideways bias between S1 and R1. So S1 being at 1.3475, R1 at 1.3590. Moving on to the Aussie. The Aussie is still in between our S1 and R1 resistance line. We are seeing a violation of a prior lower high. I would be maintaining a relatively sideways bias with RSI being at 58. It does imply a neutral market sentiment, slightly towards the bullish side, yes, but it hasn't broken above R1 at 0.6795. As long as that remains intact, we would be maintaining a sideways bias between S1 and R1. For today, though, it does appear to be reaching for that R1 level of 0.6795. On to the Swiss franc, continuing in its downwards motion. We do have S1 placed at 0.8330, or one is at 0.85550. So that is still valid and has been respected. In addition to the downwards moving trend line, we would be maintaining a bearish outlook for the US dollar against the Swiss franc. S&P 500, so the US stock markets with the validation and the flip towards the 50 basis point cut, may be finding support. So we are seeing a bullish market, I'd say, currently. So this was a reversal, moving higher. Doesn't need to clear that and aim for that all-time high figure of 5,720. I'll come back and I'll fix the technicals for the S&P 500, Nasdaq, and Dow Jones towards the end of our session today. For now, I would like to place a bit of emphasis on oil, since we mentioned that with the Canadian dollar before. This is resistance turned to support, and that is indicated by also flipping our text label. This becomes green. Support. The next potential target for the bulls could be the R2 level, which is now R1 at 71.40. Higher than that, we have R2 at 78.75. But given the distance between S1 and S2 now, we could find a more intermediary resistance line. Nicely around here, found support, acted as resistance here as you can see. Support broke below, acted as resistance, managed to break above, acted as support. So 73.50 would be my R2 resistance line. 75.30, not 50. R3 remains the same. And this is the text label I was looking for. This becomes S1, this becomes S2. I'll be having a look at Microsoft, which announced a 60 billion stock buyback program, in addition to Intel as well, who announced that it will be supplying Amazon's chips, which is a good sign for the company. There are a few issues, though, for Intel on a more macro perspective, and I'll get into that once we begin the company's stocks technical analysis. So this is S1, S2, S3, R1, R2, R3. Upwards moving fashion, R size at 50. Bullish outlook would have to clear that R1 level, otherwise it could stay between S1 and R1. On to gold. Gold made an all-time high at 2,590.35. So that is R1. So 2,530 is now support. So that is our S1. So I do need to fix this. What I'm currently looking at, because we are on the daily chart, I would like to point you towards this bearish candle that is being formed. This bullish candle is higher than the left one and higher than the right one. If this candle ends in the reds, right, and is below the wick of this bullish candle, this could be a new high. And thus, we could see gold moving in a relatively downwards fashion, potentially down towards support at 2,530. Now, the issue is the core retail sales rate. So if the dollar does weaken, then gold's price could move even higher. But the pattern formation I'm seeing now does imply a potential reversal down to 2,530. The RSI, though, is very close to 70, so it does imply a strong bullish market sentiment. But if this closes in the reds today, potential reversal down to that S1 level that we have placed together currently. We will be reviewing for the rest of the week these charts together. So we'll be making an update. We'll be readjusting our support and resistance levels on a day by day basis up until Thursday. So we have R1, and then we have hypothetical resistance, and then I place it at 2,700 hypothetical resistance at R3. So 2K 2.7 becomes R3. So overall, we could maintain a bullish outlook for the precious metal. But as I've said, this bearish candle does look like it's going to be the beginning of a potential reversal down to S1. That remains to be seen. And now we have made our way to Intel. Intel now warrants technical analysis in terms of support and resistance levels. So past few times we've simply skimmed above Intel, but now Intel has announced that it will be producing chips for Amazon. That is a good sign for the company. It might improve their sales and essentially good for revenue. So slightly bullish on Intel stock price. There is a bit of an issue. The company did announce that it would not be building the chip manufacturing plant in Germany. That decision has been delayed for about 2 years. So they won't be building that. Now, a few of you could look at this from two different points of view. One, potential funds that had been earmarked for the production of that factory will now be available for the company. So instead of bearing that extra cost in Europe as well, they are reducing that cost, which might be good for them. The issue is, though, if you're not expanding, you're not growing. So although the company stock price could improve today, I would be more from a more macro perspective. If the issue is Intel's funds. Now, if they manage to improve their balance sheets, reduce costs, and then come back to Europe and build those plants that they said they were going to, from a long term, that's very nice. For now, I would be a bit skeptical. I think there are still issues in the company, but based on the recent announcement about Amazon, I would maintain a bullish but a cautious bullish outlook for the company stock price. To the technicals, we have support at 18.90. I will be adding that text label now. So this is S1 18.90. The RSI is on 50, so it's bouncing off and moving higher. That is nice. Does imply that the bearish sentiment might be fading away, so the bulls might be taking over the direction of the company's stock price. That is a good thing. And now I need to find resistance. I'll put in the other support levels once I'm done with the resistance. High 22.10 R1. And then prior low, $4 difference. We could put at 2470. Touched, moved higher, came back down, found indeed support and moved higher. So valid resistance level. And now we need something else that is closer to R2. So we are hunting for another resistance level. I'm looking at prior highs and prior lows. I'm trying to gauge upon which there was more price action and which acted as a more crucial resistance level. Let's see. So if we use this as a benchmark, then go back, broke above, found support, open. So found resistance, broke above, hammer formation, reversed, but still was above. Came, found support, managed to break through, move lower, managed to break above, found support, broke below. Resistance, support, resistance, support, support, resistance, broke above. So 28.02 is my R3 level. And now begins the creation of the text labels. That being said, yeah, we do need to find our imaginary support levels. So if I'm placing the distance between R1 and R2 at approximately $2.60, that means I would be placing my S2 at $16.80. Pure speculation, 1680. And then distance between R2 and R3 is about $4, $3.70. So 13.10 for my S3. And I should zoom in. So 1890 for S1, 1680 for S2, 13.10 for S3. I'm simply looking at this gap that was formed. Usually gaps are filled. So if Intel manages to improve their sales and then in their next earnings report things go well and they reintroduce dividends, this gap could be filled. But that depends on the size of the contract with Amazon. For now, we are bullish. We are bullish for the company stock price, but it does need to clear 22.10. If it doesn't, sideways between S1 and R1. Bollinger Bands have narrowed between S1 and R1, so that could further imply a neutral market sentiment, so staying between S1 and R1. If it clears S1, if it clears R1, next target could be R2 at 24.70. So I will be placing those text labels. And then we have R3 at $28 per share. Nice. So you have S1, S2, S3, R1, R2, and R3. It's nice. Microsoft double top, reversal, look above. We are bullish for the company stock price. And I'm looking at the on balance volume. Money's flowing in, supporting the current trend of the company stock price. That is nice. It's broken above. Let's see here. Voila. Note how the breaking above the 425.04 resistance line. So this was a place that we had mentioned before. Look at the on balance volume, double top, pierce below. So double top was here, also implying that it was finding resistance, so moved lower. But then it has broken above a prior high as well. So that for me is bullish for Microsoft. Stock buyback program as well. Good signs for the company. Bullish outlook for Microsoft stock price. This is not resistance, this is support. I'll place this as S2. I have my R1 target of $437.90 per share. That is very close to the current price action, but still, that is the R1 I will be using. For the bullish outlook to continue, it will have to clear that R1 level. Next target could be R2 at R3 is too far away. Mhm. So between R1 and R3, $453.40 per share. And then we have S1, 425.05. So this becomes S3 and that becomes S4. Not the objects list. And then 402.10, that becomes RS2 level. So we are using the daily chart. I have placed the support and resistance levels. Yes, S1 is fairly close to R1, but overall we are bullish for the company stock price. It's broken above, it's on the upper band of the Bollinger Bands. So a small reversal would not be a surprise, but looking at OBV and the RSI at 60, both tend to imply a bullish market sentiment. Moreover, we could draw an upwards moving trend line from this low to this higher low. That is nice. This could be an ascending triangle as well, had, it, had this not pierced that S1 level. So we are just simply using that upwards moving trend line. Bullish outlook for Microsoft, looking good, really nice. And then I want to see something. So let's say, so that peak coincides, ooh, broken above. I'm going to remove this. We can keep these as they were. But overall, it is looking nice for the company stock price. So bullish for Microsoft. Nvidia, it's okay. ExxonMobil, oof. ExxonMobil touched RS2 support level at 1.08.18. So I placed this. We were saying that it was moving in a relatively sideways fashion. The second it broke this channel, it moved lower. And where did it move towards? RS2 support line. So it does show that we were correct in placing that S2 support line. Now this could be a retracement coming back up to that S1 turn to resistance line. If it meets resistance, could move lower, and the next target could not be S2, could be S3 as well. Because if it's going to form a new lower high, that could mean the bears are accumulating orders and might be pushing the company stock price even lower. Now, there's no reason to change it currently. We're going to be looking at this tomorrow as well. So that S1 is currently R1, R2 is 119.53, R3 122.95. If it bounces off and below S1, actually let's just change it. I mean, we are doing it anyways. So this is R1, needs resistance. Next target could be S2 or partials at S2, and then target could be R3. So this becomes S1, S3 becomes S2, and then I do need to find our new S3 support line. It looks like we are correct for Microsoft, uh, Exxon as well. That's nice to see. Coinciding with the opening of this bullish candle, the wick here, close to that wick as well, 98.15 as our S3 support line. So that is nice. Let's see, S&P, the FTSE 100, McDonald's. Once again, correct about McDonald's in terms of the support and resistance levels. Simply look at the resistance levels that we had placed maybe months ago, validated here, found resistance, so an actual resistance level, managed to break above, found resistance, acted as kind of support. Note this wick, moved higher. Bullish for McDonald's as well. IBM, looking good. Copper, now we need to put in the new one. Louis Vuitton does appear to be moving in a downwards fashion, taking in for that 594.54 support level that we had mentioned. Surplus, Volkswagen. Volkswagen, once again, correct with the support levels. Broken below, acted as resistance, came back down. This acted as a resistance, managed to break above, acted as support, and then oldest one, which turned to resistance and now is now acting as resistance. So that's nice. 50, not exactly bullish. I still think the company has issues. Rolls Royce, Deutsche Bank, sideways between that S1 and R1 level. It's good to see as well. Did we do? The question is, did we do the bank? It doesn't matter. We have time for one more, and then we could look. Let's look at the tech sector. So let's look at the Nasdaq 100. R1 is 19,995. R2 is 20,960. And then R3 is 21,850. For support, we had it placed at 18,630. Some of you may have seen that it did pierce through. So we do need to slightly readjust those support levels. Very nice on the opening of that bullish candle. Bearish and bullish. Very nice. So readjustment there for that S1. 18,385. So that is our S1 level. So we had, let's take this, make this S4. Let's make this S3. For the Nasdaq, the RSI is at 55, which does imply neutral market sentiment. But if we extend this upward swing trend line which was placed, coincides with that bullish candle and that bearish candle slightly, despite that wick. Now, this is a high, a lower high, lower low. For a bullish outlook, I would require a break above 19,995. Otherwise, I would be maintaining a sideways bias for the index. I think it will depend on the retail sales rate today. It takes an even greater importance in gauging the resilience of the US consumer. And given that we have the Fed's interest rate decision, which is set to occur as well this week, how resilient the US consumer, I think, will play a very big role. For example, if the US consumer is spending more, so the retail sales rate comes in better than expected and is in positive territory, it would imply that the US consumer remains resilient in spite of the higher costs, so inflation to their goods, etc. That is a good sign. It shows that the consumer is still spending. That could in turn reduce expectations of a 50 basis point cut. In turn, that could weigh on the Nasdaq. And then we could have the Fed's interest rate decision, in which they cut by 25, for example, hypothetically speaking, of course. And then the accompanying statement is very dovish in nature. And then we could see the Nasdaq moving higher. So the retail sales rate today might play an even crucial role than what is being generally discussed. For me, it is make or break. If, on the other hand, the retail sales rate comes in lower than expected, which implies a weakening from the consumer side of the US economy, it could amplify that 50 basis point cut and, in theory, could weigh on the US dollar and thus could provide support for the Nasdaq. But as we said, and as I've been saying for the past few months, if they cut by 50, I would be more worried because it would show to me that the Fed is concerned about a recession in the US. 50 is insane. Well, not insane, excuse me, that is the wrong choice of words. 50 is what the market is currently predicting, so it's not insane. For me, that 50 basis point cut would be very concerning. It would show that the Fed is very concerned as well, and thus I would be concerned too. But still, that is the market expectation. If that changes towards the 25, we could see repositioning, and we could see the Nasdaq potentially moving slightly lower. But overall, if the Fed does begin cutting rates, it means that the tightening of the Fed is on its path to end, and thus overall could provide support for the U.S. equities markets. But I would be very cautious about a 50 basis point cut by the Fed, as I said during my other live technical analysis sessions 2 weeks ago. And with that, that does it for today. I will see you all tomorrow. We'll discuss the financial releases which are set to be released today. We'll also discuss what's in store next week as well. And we'll look at the euro, US dollar, again, equities, and we'll have a recap for those. So thank you all for watching, and I'll see you all tomorrow.
Okay, I'm gonna go ahead and get started. Okay, so welcome to today's webinar. As per usual, a risk warning and disclaimer before we get started. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. A disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. The material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, so I'm Melanie and I'll be your speaker for today. I'm an investment analyst from Rocket, who were finalists for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. We're going to start off by looking at how exactly you can trade a breakout by looking at price action. And then we'll look at some candlestick breakout patterns, followed by pullback, support, and resistance. For bullish as well as bearish breakouts. And then we'll look at correlation, followed by multi-step stop loss and picking your entry and take profit. Okay, let's go ahead and get started. So here's our price action trading approach. Firstly, let's talk about reversal and then we'll talk about breakout. So why is it not? Okay, so this is basically the reversal. The reversal occurs at the edge of our channel, right? So you can see price bouncing off of that channel. Here, price is moving in an ascending trend channel. So you can see price recently reversed off of that the top of the channel. And then we see this morning star formation forming here. And if you're not familiar with candlestick patterns, not to worry, I will go through some of the formations, top used formations in the next couple of slides. But here we have a morning star formation giving us a reversal pattern. Okay, giving and then Christ then breaks above this what we call an overlap level. Overlap basically means that there are swing highs as well as swing lows that line up in that same area. Okay, so with price lining up, price breaking out of that um overlap area, we see that bounce over here and it breaks out of this area here. Okay, so the breakout now happens out of this resistance area. Okay, so as I mentioned earlier, overlap occurs when you have swing highs and swing lows that line up. So we have two swing highs and one swing low here. So we're looking for this resistance area to break out of. And you can see there is this formation here as well. I'll go through this in a bit. And this is called the three white soldiers, and you can see price breaking out of it. So the three white soldiers basically means that prices, it gives us a signal that prices are going to continue in this uptrend. Okay, so it's breaking out of that level and we expect it to continue, which it did here. Okay. Okay, so now let's talk a bit about the anatomy of candlestick, and we'll briefly go through the different breakout strategies for candlesticks in a little bit. So you can see this is the anatomy of a bullish and bearish candle. Starting off with bullish, we have the high price, close price at the upper wick, and the body, followed by the body, and then the open price and the low price. Whereas for a bearish candle would just be the opposite. So starting with high price again, the open price occurs at the start of the or the top of the body, and close price occurs at the bottom since we are going in a downtrend. So the open price would be here, close price here, and then your low price is just the tail of the candlestick. Okay, so let's start off with our top three candlestick patterns. Okay, let's firstly look at the hanging man. Excuse me. So with our hanging man, you can see prices are just moving downwards at the start. Okay, starting off with hammer, we'll get into hanging man in a bit. Hammer's just, we're just looking at this one candlestick here. So it's a shorter upper wick, followed by a small body, and then a long bottom wick. The hanging man would just be the opposite of that. So these kind of tell us that we can expect a reversal in price. So here for the hammer, prices are moving in a downtrend. Once we see this hammer, it's a indication that prices are going to reverse and head upwards. Hanging man would just be the opposite of that. Okay, next we're looking at inverted hammer and a shooting star. So again, these two are signals that prices are going to reverse off of whatever these levels are. Normally, prices will reverse off of pullback levels, so your support levels or your overlap levels that we went through earlier. And I'll go through a couple of pullback levels as well in the coming slides. But basically, inverted hammer occurs when prices are moving in a downtrend, and then we see this and we're expecting a reversal to an uptrend. Shooting star occurs in an uptrend. Once we see this, we're expecting prices to go in a downtrend. So pretty straightforward so far. It's more about being able to identify these candlestick shapes. And the last single candlestick pattern that we have are the doji candlestick patterns. Okay. So for our dragonfly doji, it's a sign that prices again are going to reverse. But instead of having our usual body of a candlestick, we are greeted by this T kind of shape. Oop. So if we go back, you can see in our previous two slides, we see this very small hammer candlestick shape. Here instead, we see this T shape, followed by the gravestone doji, which is just the opposite, prices moving in an uptrend. Once you see this, we're expecting prices to move in a downtrend. Okay, so the reason for this kind of doji candlestick shape is because it forms when the open and the close price are equal or very close to equal. So that's why we don't see this body candle of the candlestick shape forming. So it's typically considered a neutral formation, um, suggesting that there's kind of an indecision between buyers and sellers. Of course, here we're seeing a bearish bias. Here we're seeing more of a bullish bias, but depends on the price swing and the general trend as well. So all of these three candlestick patterns that we've gone through so far give us a reversal candlestick pattern. Okay, now let's move on. I'm gonna look at um oop, yeah, the next double candlestick patterns. So for these two, they're gonna be two candlesticks instead of one. So here we have the bullish engulfing and bearish engulfing candle. Okay, so bullish engulfing basically is a sign that prices, you can see it's red first, means that prices are moving upwards. The open is here, close here. So our bullish candlestick that follows that basically closes above the previous candle's open. So previous candle's open is here, bullish candle's open would be higher. And the length of the candlestick should be engulfing or rather longer than the previous candlestick. That's why we call it engulfing. Okay, so it engulfs the previous red candle. Bullish candle then opens at or lower than the previous candlestick's close. Okay, oop. If we look at the bearish engulfing, you can see that the shape is kind of similar. Prices again, your open is here, or rather, I guess here would be your close and open here, but it's kind of the same concept. So your open would just be here, or rather here. Okay, so it opens either at or above the previous candle's open, and it will close lower than the previous candle. Okay, so the main feature of this candlestick pattern is that the second candlestick's body just has to be longer than the first, and that's why we call it engulfing. Okay, both of these signals are more likely to signal reversals when they are preceded by four or more candlesticks. And we'll show you some examples in a bit as well. Okay, let's move on. So the next is our tweezers. So for tweezers, you can see it's a repeated shape. Basically, there are no upper wicks for both of the candlesticks. For tweezer bottoms, prices are moving downwards, and this signal is a sign that prices are going to reverse into an uptrend. Then the opposite would just be tweezer tops, in which prices are moving in an uptrend, and when you see this kind of candlestick pattern, it's a sign prices are going to reverse into a downtrend. Okay, I think these are pretty straightforward, and these candlestick patterns can often be found with an established support or resistance from your previous price movements. Okay, let's move on. Now we're gonna look at the top three triple candlestick patterns. Okay, starting off, we have our um morning star, morning star and evening star shape. Okay, so starting off with morning star, you can see prices are moving in a downtrend. It starts off with a large bearish candle, followed by a smaller bullish or bearish candle. So this doesn't have to be bullish, it can be bearish as well. And then last point would be a large bullish candle. Okay, and then we are expecting a subsequent bullish price action. Okay, of course, the opposite would happen for our evening star. Prices are moving in an uptrend first. It's made out of a long bullish candlestick, a smaller bullish or bearish candlestick, and subsequently a long bearish candlestick. And then we see a bearish price movement subsequently. Okay, so one of the limitations of this candlestick pattern is probably um it's quite risky because it's not really backed up by volume or some other indicators. So for example, previously I was talking about how the tweezer candlestick patterns are quite often accompanied by support and resistance levels. That's from previous price movements. So for this candlestick pattern, if you're just looking at it on its own, it might not be a very reliable signal. So normally with these candlestick patterns, we would use some other indicator as well. So if you're able to find support and resistance levels, that's great. But if not, we would use RSI as well to determine if prices are currently oversold, for example. So if it's oversold and we're looking at a morning star, then you know you have confluence and confirmation prices are gonna reverse and move in an uptrend. Okay, and of course that would be the opposite for evening star. Okay, next, let's look at our next candlestick pattern. We have the three black crows and the three white soldiers. So for these candlestick patterns, you can see it's pretty straightforward. It's just basically a continuation of um, whatever the trend is. Okay, so if we look at the three white soldiers that we saw earlier, prices were already moving in an uptrend. And let me go back to the example at the start. Mm, okay, so here we saw the morning star formation, which I'll get to, which we saw earlier, and then prices moving upwards. The three white soldiers, okay, you can see this formation happening here. So it's not really a sign of reversal, it's more of a sign of continuation. Or if prices are breaking above a specific resistance level or support level, that's also a signal for breakout. Okay, so here's the three white soldiers, and we subsequently saw prices breaking out above the resistance level. Okay, so I think it's pretty straightforward. The candlestick patterns are just basically three consecutive bearish or long bearish or bullish candles, depending on the three black crows or three white soldiers. Okay. Lastly, our top three triple candlestick patterns are the three inside up and the three inside down. For this, We're basically looking at um, a double candlestick here. The main point would be that the bottom of the candlestick should line up with the previous candlestick. And the second candlestick should also be shorter than the first. Okay, and that's the same for inside down as well. Okay, these are also reversal candlestick patterns. So you can see prices are moving in a downtrend. Once you see this candlestick formation, we are expecting prices to reverse into an uptrend. And similarly for three inside down, uptrend into a downtrend. Okay, so this basically shows that this current trend, so if it's a bearish trend, it's basically a sign that your trend has lost momentum, and so a move in the other direction might be showing. So that's for three inside down. If it's a bullish momentum, it's kind of losing that uptrend and then moving into a downtrend. Okay, so these work better in a trend, so a specific trend, and it's not so good in markets that are moving sideways. Okay, let's move on to the top three reversal patterns. So firstly, we have the head and shoulders top. You can see the pattern basically starts off with a left shoulder, a head, and a right shoulder. So the swing high is over here. And this trend basically signals a bullish to bearish trend reversal. So prices are hitting break out of this neckline and heading towards our target over here. Okay, so the neckline basically occurs when you connect the bottom of that reversal from the left shoulder and from the head. When you connect that, that's your neckline. Oops. Okay. Okay, so this pattern is actually considered one of the most reliable trend reversal patterns, and it's one of several top patterns that signal with varying degrees of accuracy that an upward trend is nearing its end. So we see prices making higher highs and higher lows, as you can see from this trend line here. Once it breaks out of that trend line, then you have kind of downward confirmation that prices are going to continue to drop. So you would put your target over here. Okay, next, let's look at the head and shoulders bottom. You know, this is just the opposite of the head and shoulders top, or it's also called, I believe, inverse head and shoulders. So, but it's basically the same thing. So it's basically identified when the price action of your security or your asset um price falls to the trough firstly, and then falls below it. So it makes a lower low and lower highs, and then it rises again, and then it falls again, but not as far as the second trough. Once the final trough is made, which was basically the head, then price would hit upwards towards that resistance. Resistance here means this neckline level. So again, the neckline is when your swing high connects with your second swing high of the left shoulder and the right shoulder. So once that's made, once price has broken out that neckline, then you're going for a buy towards our target. Okay, so this pattern is quite recognizable as well to an experienced trader. So it's quite easy to use if you're able to recognize it. And also if there are very big market movements, you can time frame for the head towards your shoulder pattern is fairly long. So you can profit quite a bit if market moves significantly from your entry, which could be here, towards your target. Okay, so where would you place your stop in this case? Your target be here, you will place your stop somewhere below the neckline. So it still gives it some room to move around without you getting stopped out immediately if price does start to reverse. So it gives it some room to move or reverse back, and then it can still shoot up to your target. Okay, now we're looking at our double top. Again, double top formation patterns are quite easy to identify. You can see basically two triangle shapes. And these normally are they are bearish trend reversal pattern. So prices are moving in an uptrend, and once you see these formations, you're going for a sell towards a target that's somewhere below. The target, so the distance between where you enter versus your target profit should be about that same length or the same height as your triangle shape. Again, so that it gives it some room to breathe, some room to reverse and move around, but still make it to your target. Okay, so this is a very bearish technical reversal pattern because it basically shows that asset has reached this high price um, two times consecutively, but it has failed to move past that price. So it then shows a moderate decline. So yeah. So if you use this double top pattern with um a momentum pattern, so it could be maybe a MACD, it would be quite a bit more effective instead of just using a resistance level over here. Okay, so a double bottom, of course, would just be the opposite with prices moving in a downtrend and it tests this support level. It's unable to drop any further, so then it reverses twice consecutively and then moves upwards moderately towards this target. Again, your target level should be the height of your candlestick patterns. Okay, so one way to identify it and avoid any false signals is to look for that upswing, or in this case would be a downswing. So the price movement should be clearly indicated in a downtrend prior to the creation of this pattern. So this basically indicates that price has been making continuously lower lows and lower highs, which we see here. You can see this low is followed by a lower low. The high is followed by a lower high, or here as well. Okay, and then you want to make sure that you're able to find that initial trough. If we're looking at the double top, then your initial peak, um, because this would be the maximum level. So if price manages to break above it, that's not really a sign of a double top. So we find the trough again, and then your second peak price should more or less stop around that same level. Okay, it might even fall short of that first peak's height because price will kind of begin to collapse once more. Okay, and then once you draw this neckline, this dotted line, then you can go in for your sell or for your buy towards your target, which would again be that distance. Okay, okay, now let's look at our last pattern, which is your triple top. So this image is from Investopedia, but basically when you have a triple top, it's basically telling you that an asset is no longer rallying and that lower prices are on the way. So again, it's a bearish signal. So, okay, I guess the most significant shape here would be obviously the triple top. And then once price pulls back below that swing low, the two swing lows and the two troughs, then price breaks below the pullback lows, and then your pattern is complete. So if you're a trader, you would exit longs or enter shorts when the triple top completes over here, once it breaks below this pullback low. Okay, so if you are going in for a sell, in this case, if you're looking at triple top, you'll be going for a sell. So from here, you're going for a sell, you can place your stop loss above that resistance level. So above this triple swing high over here. Okay, so those three consecutive peaks are very similar to that head and shoulders pattern that we looked earlier. But in this case, your middle peak should be nearly equal to the other heights, the other peaks, rather than being higher. So it's also similar to the previous double top pattern that we looked at when the price reaches your resistance area twice, creating a pair of high points before falling. Okay, so it's traded essentially in the same way as your head and shoulders pattern that we went through earlier. Okay, looking at our triple bottom, again, we have that same shape. You have three swing lows instead of swing highs in this case. But it's basically the same. Prices break out of this neckline, which again is the connecting line between your swing. Here would be swing highs. Between the swing highs, once price breaks out of that, then you can go in for a buy towards your take profit. In this case, your stop loss would be below your triple bottom. Okay, I think my camera froze there for a bit. Can you guys see me now? Okay. Okay, now let's look at the top three breakout chart patterns. Okay, firstly, we have the falling wedge. So we are going in for a target, in this case, that's at least the size of a chart pattern for wedges and rectangles. Okay, so we have the shape that we're looking for here, and here's an example of what the falling wedge pattern looks like on your charts. So basically starts off with a rising trend, followed by a downtrend or your correction, and then it breaks out of that. So we're expecting prices to break out of it here and head towards our take profit. Okay, so falling wedges are bullish signals. Okay, one of the most I guess the easiest way to identify these is by looking at your trend lines. So here we have 1, 2, 3 swing highs. Once you connect those levels, you form this descending trend line. And if you connect these two levels, you also be drawing your trend line and you can kind of figure out this shape as kind of a converging, the trend lines are kind of converging on your price chart. So that's an easy way to identify your wedge. Okay, so quite obviously the lines show the highs and the lows are either rising or falling at different rates, so it gives the appearance of a wedge since both lines are kind of approaching a convergence. Okay. Um Okay, let's look at our bullish rectangle. Can you guys still see my screen? My screen suddenly blacked out for a second. I'm not too sure what happened. Can you guys see me? Okay. Okay, good. Because my on my side my screen suddenly blacked out, so I'm not too sure what was happening there. But okay, getting back, we're looking at our bullish rectangle pattern. So basically what we are expecting here is prices are moving in an uptrend first. They're kind of moving sideways within this rectangular shape, and then we're expecting it to break out. So once it breaks out of this I guess trend line, once it breaks out of that, we have upside confirmation. The prices are going to continue upwards, and then we're going into for our take profit. Okay, so it's pretty straightforward. Basically consists of two parallel trend lines. So once you connect, again, for all these patterns, you're basically connecting the swing highs and the swing lows to form your pattern. So that makes it easier to spot any shapes as well. So your lower trend line acts as a support level, this one here, and your upper trend line here acts as a resistance level. Then these trend lines create kind of a rectangle shaped pattern. So this is what we call a consolidation phase. So during this pattern's formation, price moves sideways between the two trend lines. Okay, so yeah, this is called our consolidation period where neither your buyers or your sellers are in control and there's no real, I guess, trend. Okay, once the breakout happens, it actually breaks out above this entry and we're going for a buy towards our take profit there. Okay, next we have our bullish pennant pattern. So for a pennant pattern, we are looking for this kind of a shape here. Okay, so this occurs again after an uptrend. So you can see prices moving in uptrend here. And it indicates a potential continuation for upward movement. Okay, so this I think this bullish pennant name is also a flag shape, if I'm not wrong. Because this is commonly this line here, this shape is commonly referred to as a flagpole because it kind of resembles a flag shape. So once prices are moving in this bullish shape and it breaks out of this flag shape, then there is strong upward movement of the price of your security. Okay, again, the consolidation phase would be over here where there's no real trend. And the breakout from this consolidation period basically forms forms this triangle shape or like pennant shape, and then it'll happen upwards. So break above this trend line and hit towards our take profit. So you want to make sure that you don't place your stop loss too close to the bottom of your shape. Typically you place it below the first swing low, so it gives it room to breathe, so you don't get stopped out here. Okay. Okay, are there any questions so far? Okay, if not, let's move on to combine these patterns with what we've learned so that we get a better, higher probability breakout strategy. So if you guys have joined us for a while, you would know the support and resistance patterns that we use, the trend lines, oscillator indicators, and momentum indicators. Okay, but if not, I'll just briefly go through them right now. So earlier I mentioned support and resistance. Obviously, it's just the price at which an asset tends to stop falling, which will be your support, or stop rising, which is your resistance. Okay, and you use technical analysis tools like your trend lines, moving averages, chart patterns, so on and so forth. And we normally take note of these levels at your swing highs and swing lows. Okay, yep, so some things to take note of. In significant swings, you want to avoid using these levels as your support and resistance levels as well. Yep, here's another example. This is something that you should look out for. Significant moves up or down, obvious peaks and troughs, and clear market movement. Okay, another example here. So support and resistance levels obviously can be used as take profit and stop loss levels. However, using a recent swing high or low is a weak level if it's the only level. So that's why we mentioned using multiple swings, where at least two swing high or lows line up nicely, and it's a much better level to use. Okay, so some starting points. When picking your points, you want to make sure that there is a swing high or low, pullback or overlap level to start from. Go as far back as possible, and you want to make sure that you are just intersecting the wicks and not the bodies of the candlesticks. So for example here, you want to make sure there's a very clean cut of your candlesticks and you're not really doing this here where it's too messy. Okay, some more examples. Okay, now let's talk about the pullback and the overlap, support and resistance. Okay, because we've been mentioning pullback and overlap quite a bit in the previous slides. So if you're unfamiliar with what a pullback support is, it's basically a um when it breaks out. So you can see here, for example, in this GIF, price is at a swing low, okay, and price has broken below that level. So it's a pullback level because we are expecting price to revisit it over here. And once price has revisited it, it then becomes an overlap level where your swing high and your swing low line up. So the pullback is kind of the in-between level before it becomes an overlap. Okay, so here's an example. We have three swing lows, making it a support level. Once price breaks below it, it then becomes a pullback level, and we're expecting price to revisit it and reverse off of it again. If we're talking about the support, prices are moving, prices react off of this resistance level at first. And once price breaks out of it, it then becomes a pullback support, and we're expecting price to bounce off of that level. Okay, combining both, here's an example. Using a big swing high resistance, the moment price surpasses it, it becomes a pullback support, and price has made a pullback to our pullback support level and bounced off of it perfectly. And the moment price bounces off of it, it then becomes a overlap support. Okay. Yep, here's another example. So you can see price normally does come back to revisit it after, since we have price bouncing off of it again here as well. So we can combine these with trend lines as well. If you're able to spot any of the candlestick pattern formations that we mentioned earlier, especially if you link them up with any of the pullback and overlap levels that we've mentioned, that will really strengthen your analysis. Combining them with trend lines, of course, this only works in a trending chart. If not, you can also look at any patterns that we went through. Okay, and combining it with channels as well, resistance, and like we did earlier as well. Okay. Yeah, I think that's all I have for you guys for today. Are there any questions? Okay, if there are no questions, um, that's it for today. Thank you guys so much for joining me. I hope you guys found this session helpful, and I'll see you guys again next week. Thanks, everyone. Bye. Thanks, everybody. See you guys next week.